Let's continue our conversation with Bryant VanCronkhite, portfolio manager with Allspring Global Investments, who is back with us with a stable connection. Bryant, thanks for holding. You were talking about the importance of tomorrow's CPI number. We're also heading into the start of earnings season. We had this conversation last hour that maybe the number of rate cuts on the table won't matter as much because the economy will be strong. What do you think?
Well, I think that's one thing to think about. I think the first thing is not to put too much importance on the singular data point tomorrow. I look back at the bigger picture, and I was saying before that employment looks really tight despite immigration benefits and AI benefits potentially. I see growth remaining very strong, to your point, and those aren't supportive of a cut. And then I look at some other data points. I see the NFIB index at its lowest point since 2012 because inflation continues to bite the hand of the small business owner. And the Fed's very own survey data suggests consumers think inflation will stay above their 2% threshold for the next 1 and 3 years. So taking a step back, a nice cool print would be welcomed by the market. But the bigger picture shows a lot of reasons the Fed could stay on hold for longer than the market's pricing in right now.
You say you're cautious on the consumer, therefore you're overweight consumer staples, but lighter on underweight consumer discretionary. Why are you worried about consumers?
Well, right now I'm seeing some evidence of the consumer's ability to spend beginning to fade. I think the consumer has held the economy up very nicely, and we welcome that for the last 2 years. But I look at delinquency rates, for example, with consumer credit beginning to get back to those pre-COVID heights. I see the ability for additional capital to be spent from excess savings really starting to fade away. I see some data from companies showing the consumer is making tough choices, trading down and making those baskets a little smaller. All that suggests to me the consumer is pulling back, which could put pressure on growth. So all else equal, I want to fade the discretionary decisions that consumers make and really lean into the more defensive situations like consumer staples with beverages and some of the more stable consumer packaging companies.
Brian, how do you think that's going to play out over earnings season and impact forward guidance?
I think that's a really big question right now. Investors have to see companies provide optimism around their guidance given where we are with valuation. So right now I want to own companies that maybe have less sensitivity to the volatility of the economy, where you can be maybe more confident or in a tighter range of demand, and then sprinkle in offense where I think the market's been scared. For example, commercial real estate has been the poster child of risk for this current cycle, and most of it's tied to some eye-popping stats around office property, for example, but that exaggerates the reality. A company like CBRE is a great way to play offense in an otherwise market where I want to be cautious because they've been investing through this cycle, and their business is largely based on transaction volume, not prices. And if the market stabilizes rates or the Fed cuts, we could see their volume pick up. We can see their earnings accelerate higher, and they're at a trough right now, while a lot of the more offensive buckets of the market are not at trough.
Where are you on bonds and investing in fixed income right now? Is it an opportune time to do that? And if so, where?
I think the fixed income market could be interesting. We're talking about pushing out on the curve right now. A lot of money is in money markets, which tells me that the market is still defensive in some respects. So hopefully any pullback we have in the markets, we'll see a buy the dip mentality as we move out of money markets, out the duration curve, and also out into equities. But right now, I like the idea of moving out duration a little bit, but with a keen eye on credit. Right, we forget that credit's incredibly important in fixed income markets. So right now, think about balance sheet strength, think about picking up a little bit yield, but don't forget credit's really important to this part of the cycle.
So, Brian, as we've watched the rise in commodity prices and some of the stocks there, the AI trade, you mentioned it a little earlier, has taken a bit of a breather. You look at an NVIDIA, which is down more than 10% since hitting an all-time high in early March. Where are you on this theme, and how does that change the market character going forward?
I'm not surprised to see some of the initial winners on the AI theme begin to pull back. It's really common for the market to exaggerate that first move out of the gate with a big theme like this. Then we'll see a pullback, and then we'll see the market underappreciate the benefits of AI over the long term.